G'day everyone, and welcome to FinChat. My name is Hugh,
My name is Hoy.
and today we'll delve into the Bank of England's interest rate rise. Earlier this week, they raised their interest rates another 0.5% to a record 5%, the highest level in 15 years from 4.5%. So, Hoy, this has been happening in unison with other central banks around the world. They're just jacking up rates at the moment, trying to stem inflation. So, could you just give us a very brief summary of, what the Bank of England is doing and why?
Yeah, so like most of the developed economies around the world, the UK still has an inflation problem. Now, inflation
Really?
is the increase in prices, general prices. Now, in May, the headline inflation it was 8.7%. The core inflation, which strips out food and other volatile prices like energy, was still high at 7.1%. That's a 31-year high. So the Bank of England had to do something, and they did it by not increasing their base rate, or as they call their official interest rate, they didn't do it by 25 basis points. They did it by a whopping 50 basis points, which, if I'm not wrong, was the biggest increase since February this year. So it's taken a lot of people by surprise, and it has created some concerns for people with mortgages, etc.
Yeah, I think it's interesting because it came as such a surprise because the Federal Reserve in the US actually did a pause in the interest rates, and they're only raising interest rates by 25 basis points as compared to this, I guess, shock 50 basis points. So does that mean, I guess, inflation is more of a concern in the UK? What are, I guess, are the drivers of inflation similar across the world? Is it sort of to do with like wage prices or more goods inflation? Just what's driving inflation in the UK or more broadly?
Yeah, typically, I mean, inflation is affected by two broad factors, right? One is what's happening globally, and then we've got to ask ourselves, well, is there anything domestically that is impacting that? So, from a global perspective, which, by nature also affects other countries like the US, Australia, Europe, food prices, oil prices, those type of things are set globally to a lot of extent, and that has been impacted by things like the war in Ukraine, and the demand for these type of things, including energy, etc., has sort of increased after the pandemic. People are going back to work, etc. So there are global factors, but in the UK case, there are also domestic factors. So, the unemployment rate has also dropped. So consensus was thinking that it was expected to rise to 4%, but it actually dropped. Now, what that means is that more people will be employed, and theoretically, when more people are employed, it will push demand for goods and services up, and therefore translate into higher prices eventually. The other factor is wage growth. Now, the UK has experienced wage growth of around about 7%. So that's 7% includes the wage growth excluding bonuses. Now, on the face of it, the 7%, I should say the 7.2% increase is the 3 months up to April. Now, on the face of it, you would say, wow, 7% is a lot. Now, remember the headline inflation, CPI, is 8.7%. So
Mhm.
although wages are growing and perhaps putting pressure on inflation, it's still running behind inflation. So you've got this sort of catch-22 where you've got, people are experiencing price hikes. They can't afford um, as much as they used to because of inflation. They're asking for more money, but then by asking for more money, it's in turn, fueling the inflation cycle. So those are the two factors.
Okay, yeah, and it's so interesting to hear that um, a lower unemployment rate is now looked at as sorry, is that a bad thing rather as a good thing? So I had this conversation with my dad, and he said, "Well, if more people are getting employed, well, why is it being perceived as such a negative thing?" And it's because that adds to the inflationary sort of pressures that we're currently seeing, which is at record high rates. And yes, central banks have a dual mandate, which is to balance price stability, but also employment stability. So you have employment out of whack, and employment is checked off, which is it's all good and dandy, but inflation is out of whack. And so the central banks are trying to, you know, put that balance into scale by raising rates aggressively to what they call a neutral rate.
Yeah. So it's one that I also picked up. So it's pretty interesting that you picked it up as well. So I thought to myself, isn't it weird that the market took the slightly reduced unemployment rate as, oh my God, it's going to increase inflation. Now, my immediate thought was, that seems very strange, right? We should be um, uh, encouraging employment because when people have jobs they can afford, they less reliant on social security, etc., which made me think then what could be done. And I thought to myself, well, broadly, if I remember to my economics 101 back in high school, is that there are two sets of levers. And broadly, you've got the monetary policy lever, which the central banks usually control. And then you've got the fiscal policy, which the government usually controls. And the fiscal policy is basically the government spending and taxation policies. And I wonder whether there are failures in the government's fiscal policy that has led to the concern that unemployment rate, a decrease in the unemployment rate is a cause for concern with regards to inflation. So I just wonder whether the government has spent or taxed in the right way.
Yeah, you make an interesting point. There are a lot of political ramifications between that divide of fiscal and monetary policy. On the fiscal side, and from a political standpoint, you want people to be able to be employed, to be able to afford their mortgage payments, and generally just have financial stability. But on the monetary side, they're more concerned of, I guess, price stability as well, in conjunction with employment stability. And that means keeping inflation in check and raising interest rates, which we've heard many, many, many times. And so I guess to my last sort of point here, Hoy, the implications of this aggressive monetary policy tightening cycle, not just in the Bank of England, but across developed nations in general, what does it mean, I guess, for the individuals like me and you and the broader economy? Are mortgage holders naturally going to be pinched? And I guess what's the state of the consumer right now?
Sure. And I think we've got to look at it, in my opinion, in a few lenses. So, what is the implication to the population itself, to the citizens of UK of a high interest rate? And what is the implication? What is the political implication? So let's take that in turn. So, and they're actually linked together, actually. So the implications of a higher interest rate to the normal quote unquote person on the street is that, if you hold a mortgage, your mortgage will increase. right? Your mortgage repayments, I should say, will increase. So, just to give you a feel that, uh, UK mortgage holders, they're around about 2 million mortgage holders in the UK. About three quarters of that are on fixed rates. Now, fixed rates mortgages are more prevalent in the UK compared to countries that I'm familiar with, for example, Australia. So in November 2021, the average cost, well, the cost of an average 2-year fixed rate was about 2.3%. 2.3%. Keep that figure in mind. Now, the same cost of that 2-year fixed rate is just above 6%. Now that's more
Sheesh.
than double. So the implication of that is that if you have a fixed rate right now, you might not be impacted by the interest rate rise. But when your fixed rate period expires, you're going to roll over at a higher rate. And you're going to feel the pinch if you're already struggling now. So just imagine that you have to pay more than double your mortgage repayment. So there's about 800,000 fixed mortgage holders that will have their fixed rates expire this year. So the concern for the government is that, will this cause a mass default, right? So, and that ties in to the political ramifications that, the Prime Minister Rishi Sunak, as part of one of his 5 pledges, is to bring down inflation to about 5%, and he's made that a commitment earlier this year. So there are political ramifications. If people feel the pinch and they don't see that the government is helping them enough, then they're going to
Um,
be voted out, right? But not
yeah,
only that, if a lot of people default on their mortgages, the economy will suffer a deep recession because you have people unemployed, you have people who can't afford their mortgage, etc. The the other point I'll make, probably the second last point I'll make, is that the outlook of the interest rate increase doesn't give you better news as well. It's not like, it's hit its peak and then now we're in for, a downward spiral in terms of interest rate. The markets are, pricing in that rates to be 6% by the end of this year. It's 5% at the moment. They forecast 6% by the end of this year. It might go up to 6.25% next year. So there's still bad news, and there's no relief in the short to medium term. So that's getting everyone a bit worried. And it will have financial implications. And as I say, what the government can do is look at their fiscal policy. They have already asked some of the banks to see what they could do to help mortgage holders, and they have responded in some of the relief packages. But the final thing I would say is that you might say, well, I'm not a mortgage holder. It doesn't affect me. Interest rates affect everyone. It can translate into, inflation affects everyone. It translates into higher grocery prices. Your rice will be more expensive. Your everything, almost everything will be impacted. So it's not just mortgage holders that are impacted. So that is my long spiel about the
yeah, no,
implications.
that helps a lot. And I mean, just a comment from me, like from an Australian perspective, a lot of so in Australia we have more variable rate mortgages than the UK, and I mean, despite that, there was an increase in fixed rate mortgage holder numbers in 2020 because of what we call a term funding facility, where the RBA kept 3-year rates at, I think, 0.25%. So naturally, that incentivized a lot of borrowers to take out these loans at ridiculously low rates. And so now 2020 plus 3 years, these mortgage holders are rolling off. So there is a impending mortgage cliff that is happening in both the UK and in Australia. Now, I can see this that a lot of my sort of colleagues who do have mortgages, they're paying in excess of 1,000 Aussie dollars a month already. This is in towards the end of a interest rate tightening cycle, but we'll probably see a bit more pain to come. And as you said, Hoy, it affects all people, regardless if you hold a mortgage or not. I don't hold a mortgage, but I can still feel the impacts of inflation from my day-to-day spending, because when I'm going out, to eat food or get a haircut, that comes to services. Haircuts have gone from 20 Aussie dollars to 30 Aussie dollars. That's quite 50% increase, right? So you can see the wages inflation is really pulling through there. But that's all we have for today. So if you enjoyed this episode, everything to do with interest rates, inflation, etc., make sure you click the like button, the subscribe button, and also the bell notification, just so that you're on top of all these developments. I'm sure we have a lot more to talk about as we see these developments progress throughout the year and into next year. So we'll see you later in the next few episodes. Bye now.
Bye.